Good morning everyone, this is Mike of MLB Accounting, wishing you a happy Monday. Today's episode talks about the so-called negative gearing, which is a tax strategy commonly used in Australia. It is the ability to offset the cost of owning the property including interest paid on a loan against assessable income. This strategy called negative gearing is often considered a tax strategy than an investment one. Since the aim is to make a profit, investors with negatively geared property either hope that one day the rent covers the loan cost or the capital growth in the property is such that they make a profit when it comes to sell. As soon as the rent covers the cost of borrowing, it becomes a positively geared property and the income might be subject to tax. Many, however, say it is better to pay tax on a profit than to make a loss. But is this an outdated strategy? For most of the 30 or so years negative gearing has been around, it has been a reasonable strategy as there are capital growth across the country. However, at the time of global economic uncertainty, betting on a capital gain from property is a risky and outdated strategy for most people. It is better to save more on deposit on a property that can then be rented for more than the weekly outlay. If it generates a capital gain, then that is a bonus. Negative gearing is beneficial only when the total return on the investment, the capital growth, and the yield is greater than the total cost. The best position is to be negatively geared but cash flow positive. The way to do this is to take advantage of the tax-deductible depreciation laid out by the tax office. The newer a property, the greater the depreciation levels. Construction costs can be depreciated at 2.5% over 40 years. The rate of depreciation varies for fixtures and fittings. The tax deduction from depreciation known as a non-cash loss and the difference between the income and expenses, the cash loss, can result in a positive cash flow from the ATO. It is important to obtain a depreciation schedule prepared by a quantity surveyor to maximize relevant tax deduction. The cost of holding an investment property can be very tax effective, especially for high income earners. There are two types of costs associated with owning an investment property. First are the cash costs, which include interest payments, bank fees, maintenance costs, insurance premium, and property management fees. And the other type is depreciation, which is a non-cash cost. If you add the amount of cash and non-cash costs and they exceed the rental income, then there is a net rental loss which may be able to be claimed against your taxable income such as your salary. I don't want to be involved in politics, but if surveys are to be believed, Labour is poised to win in this coming federal election. They plan to limit negative gearing only to new housing from the 1st of January 2020. They also plan to have the capital gain discount to 25% from the current 50% discount. But all investments made prior to this date will not be affected by the changes and will be fully grandfathered. Again, this is Mike of MLB Accounting, and I will see you again in the next episode. Happy Monday, and let us start the week right with today's Monday lesson.